Welcome back, everybody. In today's video, we're going to look at picking the right development lender to go with on your property development deals. So people often think that when it comes to picking the right bank, the right lender to go with, that the cheapest lender is going to be the best one. And when I say cheapest, I mean the one with the lowest interest rate. And that often isn't actually the case, and let's run through why. So when we look at funding our development deal, our debt is the cheapest form of funding that we have within the capital stack of that deal or any given deal. So for this reason, we always want to be maximizing the debt coverage of our first charge lending. So we want to get as much of the total lending that we need to achieve on that deal done via the first charge lending. Any shortfall between total cost and the net loan offered by the first charge lender has to be made up with other sources. So this could be your own money, and people often think that this is cheaper, and in fact it's not, because whenever you deploy your own capital in a deal, there is an opportunity cost associated with doing so, and often the opportunity cost is more expensive than any other lending cost available. So the shortfall can be made up with your own money, not cheaper. Second charge lending, again, not cheaper. And raised equity, again, not cheaper. And if you link back to our Understanding the Capital Stack video, you'll understand why this is, and it simply comes down to the risk profile associated with each of these types of lending. So that's why when we look at our first charge lender, we want to absolutely maximize the debt coverage from this lender. Typically, the bank that offers you the cheapest debt in the form of the lowest interest rate is able to do so because they are offering a low loan to value. A low loan to value equates to a low debt coverage. So they may be offering, let's say, 5%, 6% interest, but that could be capped at a 60% loan to value. So yes, it's cheap, but you're not able to access as much debt via that lender, which is why they're able to offer it cheap, because the debt they do deploy is less exposed, therefore less risky. Again, understanding that capital stack, the lower the risk, the less expensive the money will be. So when we go with one of these cheaper lenders, the shortfall between total cost and the first charge lending becomes greater, and this deficit that's been created has to be made up with more expensive forms of debt or equity. So let's have a look at a live example of this. So let's say we have a deal where the total GDV is £5.2 million, and the total costs associated with this, excluding funding costs, are £4 million. Lender A is willing to give us a 5% interest rate. However, they're only willing to go up to 60% loan to value. Whereas lender B, they are a 9% interest rate. However, they are willing to go up to a 75% loan to value. So if we just went with the cheapest, we'd instantly think that lender A is the better option because they are 5% versus 9%. But let's take this a step further. Based on these loan to values, lender A's gross loan facility would be £3.12 million. Lender B's gross loan facility would be £3.9 million. Now, let's assume the same parameters for the deal. So let's assume drawdowns are in line with a standard construction S-curve. The term of the debt is 18 months. And for the sake of this conversation, let's assume that the intro and exit fees are 1% in and 1% out. So the only variable is the interest rate. So based on a 5% interest and the initial gross loan, lender A would have a net loan facility available to you of £2.9 million. Whereas lender B, with an interest rate of 9%, would net down to a total loan facility of £3.492 million. So the senior debt lender A's debt would be about £190,000 cheaper than the debt available to you from lender B. However, the loan facility from lender A would create an additional £590,000 deficit that would need to be filled with either a second charge lender, who is more expensive, or equity investors who are even more expensive again. So potentially, when looking at the bigger picture and the overall capital stack in the total deal, lender A could end up being more expensive to you than lender B, even though they are 4% cheaper on an interest rate. So this is why when you might hear developers, brokers, banks talking about debt coverage as one of the most important metrics, that's exactly why that is the case, because your debt coverage goes on to influence everything else within the capital stack in your deal. So the second thing to consider with any lender when picking who to go with is the equity sources that they will allow for that given deal. So some banks will allow particularly experienced developers to use any soft equity, so equity they've created in that deal, as their skin in the game, so to speak. However, this is quite rare to come across. It's only on certain deals that the numbers allow for this to work. So for the context of this conversation, we're assuming that any equity going into the deal from the developer is in the form of cash, essentially, so hard equity in the deal. So when we're talking about putting in hard equity into a deal, it's important to understand the lender's requirements for the source of that equity. Now, all lenders are going to require at least a small percentage of that hard equity to come directly from the lending entity, i.e. the developer. However, many banks will allow a variety of options when it comes to that total equity piece, meaning that you as the developer are actually often able to raise a huge portion of the equity going into that deal. So for example, you could have one lender that insists that of the total equity piece required by the developer, 50% of that piece has to come from the lending equity, whereas another lender may say that actually only 5% of total costs has to go in as hard equity from the developer. Now, depending on your goals and objectives, that may influence you one way or another between those two lenders and deciding which of them is going to be right for you. If your objective as a developer and as a company is to do as many deals as possible to grow a pipeline, and you're not as focused on each individual deal's net profit after funding, then most likely you're looking to stretch your equity piece. And, most developers don't have an infinite pot of money available to them. This is a finite resource, which means when spreading it as far as possible, they need to be working with a lender that allows them to raise equity from other sources to create the total equity piece. So in that situation, you're going to be specifically looking for a lender who has the lowest equity input requirements from the developer. That is going to be the best lender for you. Another thing to consider when picking who the best lender is going to be for you and who's going to be the cheapest is the intro and exit fees. So pretty much all development lending facilities will have an arrangement fee and an exit fee. Now, these are normally, 1-2% of the total loan facility, which at first you may think, oh, what's the difference between 1 and 2%? But we can be talking about millions of pounds loan facility. Therefore, the intro and exit fees can be tens of thousands of pounds and can make a very material difference in the total lending package. So you need to consider, one bank may have a waived arrangement fee and 1% exit versus another bank who are 2% in, 2% out. Those two would be very materially different in cost and something that you should consider. Mainly, when it comes to picking the right lender for you, you need to make sure that first of all, you have absolute clarity on your own goals and objectives. And working back from that, you can figure out what does the perfect funding package look like for us. And then you try and work with banks that can offer that to you. So some things to consider when trying to pick the right lender. So one is the experience profile that the lender requires. Some lenders are happy to work with first-time developers, whereas others need a 5-year track record. If you're wanting to work with a lender that needs a track record, then this may require you to bring in a joint venture partner who can offer that to the bank, something that you may not be able to. And in doing so, you may then have to give away 50% of the profit. So it's something to consider whether or not that bank then is still the right person for you to work with. So another thing to consider when picking the right lender is the level of personal guarantee. So one lender may say we require 40% of the total debt to be covered by personal guarantee, whereas another lender may say we only want 20-25%. Now, obviously, if you were a developer who one of your main priorities was not exposing any of your other assets or minimizing the exposure of your other assets to that debt, then having a low personal guarantee could be very important to you. This may come at, let's say, a 3% higher interest rate, but if that's a priority to you, minimizing the exposure of your other assets to any debts you have, then it's important to minimize the personal guarantees associated with that debt. Another thing to consider is, are there any sort of trick clauses that could limit your total loan facility? So one thing a lot of lenders have is they mainly talk about a loan to value as their main sort of metric of figuring out your total loan facility. However, many of them actually also say a total loan to cost they're comfortable with, and it's whichever of the two come first. So say, for example, they say 75% loan to value or 80% of cost, whichever comes first. Depending on your deal, if the cost clause gets triggered first and you hit 80% of cost, this could mean that actually you're stuck at, let's say, 71% loan to value instead of the full 75%. So in that situation, you may have been better finding a slightly more expensive bank, or a bank that's got higher arrangement fees, for example, but they don't have a cap on loan to cost. So it's just being aware of any hidden clauses that could limit the total loan facility you have available to you. And then other things about basically what the rest of the capital stack needs to look like. Are they happy with mezzanine lenders? Do they have any preference as to mezzanine lenders you should be working with? Do they have any issue with private debt? Where does the equity source have to come from in the deal? Are they happy with you raising equity? What amount of equity goes in? Will they need to subordinate any of the equity that goes into the deal? Questions like this will help you paint a bigger picture as to who the most appropriate lender is for you, your company, and your overall goals. And it's not as simple as going with whoever has the lowest percentage on their interest. So I hope you guys found that useful and helpful. If you want me to cover any other topics, drop a comment below and I will do my best to cover them all in the future. Don't forget to like and subscribe to the channel, and I will see you all soon.